Understanding the basics, savings versus investments. Saving and investing are essential for financial health. They are different but work together. Saving is setting aside money for short-term goals. Think emergencies or a down payment on a house. Investing is putting money to work in assets like stocks or bonds. Investments aim for long-term growth. This could be for retirement or your children's education. Saving is about preservation and easy access. You want your money safe and available when needed. Investing is about growth. You accept some risk to see your money increase in value over time. Both are important for a solid financial future.
The power of saving, a financial safety net. Saving is the foundation of your financial house. It provides a safety net for unexpected events. Imagine your car breaks down or you face a medical emergency. Savings help you handle these situations without going into debt. Savings are also important for short-term goals. This could be a vacation, a new appliance, or a down payment on a car. By saving regularly, you can reach these goals faster. When you save, you earn a small amount of interest. This helps your money grow slowly over time. While the growth might seem small, it's better than nothing. Remember, saving is about preserving your capital and having easy access to your funds when you need them most.
Investing, growing your money over time. Investing is about putting your money to work for you. When you invest, you buy assets like stocks, bonds, or real estate. The goal is for these assets to increase in value over time. This helps you build wealth and achieve long-term financial goals. Investing is essential for retirement planning. By investing early and consistently, you can take advantage of compound growth. This is the snowball effect of earning returns on your returns. Over time, even small contributions can grow into a substantial nest egg. Investing also helps you stay ahead of inflation. Inflation erodes the purchasing power of your money over time. Investments, if chosen wisely, can outpace inflation. This helps you maintain your standard of living. While saving is important for short-term needs, investing is crucial for long-term financial growth and security.
Section 4. Risk and Reward, a balancing act. It's important to understand that saving and investing come with different levels of risk. Saving is generally low risk. You're unlikely to lose your principal, especially if you keep your savings in an FDIC-insured account. However, the returns on savings are also generally low. Investing, on the other hand, involves more risk. The value of your investments can fluctuate, and you could potentially lose money. However, the potential for higher returns is also greater. The key is to find the right balance between risk and reward based on your financial goals, time horizon, and risk tolerance.
Section 5. Tailoring your approach. Finding the right balance. The right mix of saving and investing depends on your individual circumstances. Factors like your age, income, financial goals, and risk tolerance all play a role. If you are young and have a long time horizon until retirement, you can afford to take on more risk. You have more time to recover from any potential losses. As you get closer to retirement, you may want to shift towards a more conservative approach, prioritizing the preservation of capital. It's also essential to diversify your investments. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, and real estate. This helps to mitigate risk and potentially enhance returns.
Section 6. The path to financial wellness. Understanding the difference between saving and investing is crucial for achieving financial well-being. Saving provides a safety net and helps you reach short-term goals. Investing helps you build wealth and achieve long-term financial security. By adopting a balanced approach that incorporates both saving and investing, you can take control of your finances and work towards a more secure future. Remember to start early, be consistent, and seek professional advice when needed. Your future self will thank you for it.